So in order for you to not forget that, it's very essential that you do practice on the same day. Okay. The calculator functions that you may find that, I'm not able to memorize that. Don't worry, you don't have to memorize it. That's the reason why in the notes, if you see, I have mentioned all the functions. So I've put all the functions there which you need to put, while doing the calculation. So do see those functions, PV, FV, and so on. And in case if you tend to forget what was the function for beginning or end of the cash flows, I've put that as well. Second beginning, second clear, all these minor things also I've put in the notes. So when you are practicing, do keep the OneNote open, because in the OneNote we have put the diagram, which is the timeline, the equation, and then calculation. So I would recommend you to practice the questions only after opening the OneNote. Just going through the OneNote, what we've done in the class, that is essential. And what to do? So today, we'll be finishing up with the time value of money. That is reading number 6. And after that, what should you all do? I'll describe that at the end of the session. So, how can you all practice? And I have also opened up the uh, question bank, which you can go and give the test. So I'll discuss about that as well. So 3 things, what should you all do after the time value of money is done? Where should you all practice, from which notes, and what should you all do? The second thing, how to go to the portal and give the test. And the third thing is that what you need to do after today's session till the next session. All these things I'll be discussing at the end. And also at the end of the session, the last half an hour or so, I'll also take the individual doubts in case if you have any. Okay. Yeah. So I am waiting for a few more to join. So whether it's a class online or offline, I am happy that I do get the feeling that there is a bit of late coming factor in the online as well as offline. And one more thing remains the same. The further the students are, the farther the students are, the earlier they come. So in my batch also, in the classroom, when those students used to stay too far, they used to be in the class before everyone, and those who were nearby, they used to come late. That's the case happening with online also, I think. We have international students being on time.
Yes.
So we'll wait for others to join. In between, I would suggest you all to go and practice the amortization schedule. And practice the amortization schedule. Okay, everyone. By the time we have more students joining in, I would recommend you all to go and practice the amortization schedule. Okay, so just to quickly recap what we did in the yesterday's session, we covered the present value part, where we did the present value of single cash flow, multiple cash flow, where we did annuity, and then we also within annuity we had ordinary and annuity due, and then we also had the multiple cash flow with unequal cash flows present value, where we had the calculated function of NPV. So we directly calculated the NPV, right? And after that, we did several other parts where we did present value of perpetuity. In perpetual cash flows, the only cash flow is the annuity amount, right, which is forever. So that was the case that is going to be the case in case of perpetual bonds and so on. So we did the present value of perpetuity, and after that we did the amortization schedule. In the amortization schedule, the first thing you do is that you calculate the installment, that is the equated annual amount, which can be monthly or equated annual installment, and this installment can be monthly or annually. So we calculate that amount, then we go to the second PV function, which is second amortization function, and in that P1 and P2, P1 is from and P2 is till. So from a point A till point B, accordingly, whatever the question is being asked, you can answer them based on which interest component do they want, which principal repayment component do they want, or what is the balance of the loan at the end of a particular period. So all those questions you can answer by just going to the P1 and P2 part, and accordingly, we had yesterday solved a couple of questions based on that. Correct? Now, almost everything that you are required to do in time value of money is done. Now, how this time value of money is applied at multiple places, including in the practical life, that's what we are going to see. Correct? So, let's start with the next part, and which is the discussion about, where you are given multiple numbers of these equations, and one of the number is missing. That's what you have to find. So I've taken a case where either the growth rate is to be found or the number of period has to be found, right? So these are the examples, a bit of practical examples, but here multiple things may be required to find. So let's understand what is being asked and try to frame, so until now we had done the equation of time values. Now I've created a story in which you'll have to fit in the time value, and it is essential to see how well you have understood the concept. Have you understood the concept only mechanically, or have you understood the concept from an analyst's angle, right? That's what we are going to see. So everyone with me on example 7. What is it written? We are going to solve for growth rates and number of years. So first I'll solve for growth rate and then for number of years. So here it is mentioned in 2000, in the year 2000, China's GDP was approximately $1.2 trillion. Correct? If you all are aware, 20 years back, China was not even at the stage where India is. So 20 years back, China's GDP was $1.2 trillion. And it reached to $14.4 trillion by 2020. So, almost close to USA, the world's largest economy. China is now poised to become the world's largest economy very soon. So what was the growth rate it achieved? So guys, what was the economy of China in the base year?
1.2 trillion.
1.2, and from there it has reached to 14.4. So from 1.2 till 14.4, and this was from 2000 till 2020. So what is the time frame here?
20 years.
20 years, correct. Okay, so I have everything. The only thing I need to find is I by Y, isn't it? So can you find that guys? Can you please find out what is going to be the I by Y? This is part A. Yes. Please try out and let me see how many of y'all are practicing. Yes. So what is the present value? Yes, in this case, the present value that you must have input is 1.2. Correct. The future value that you must have put is 14.4. Number of period 20. What is the PMT?
0.
0. And then if you calculate I by Y, I am Expecting some interesting answer. Yes.
Error 5.
Oh, error. Is everyone getting error?
Yes.
Everyone. Anyone has got any answers? Well, the reason is that you all have forgotten the concept that the present value and the future value both cannot have the same sign. That's why the calculator will give you error, right? It started from something, it ended to something. So both PV and FV cannot have the same sign, guys. Are you getting me? Right? So either of the factor you can keep negative, you have to keep the PV negative, you can keep the PV negative here, guys. And now if you solve this, so you just have to override 1.2 as PV negative, but and where is the negative sign? Let me show you. In the calculator, here, guys, here near the reset button, there is a negative. Don't go with this minus sign, go with this plus minus sign. So you are going to press 1.2 and then negative sign, and then you are going to put that as PV. 14.4 will be your FV, 0 PMT, 20 N, and then compute I by Y. Everyone with me? And now if you would solve, you would get the answer. So, these are the minor things, very small and minor things that you have to take care. Clear, everyone? I hope you've got the answer now. Anybody?
12.36.
12.36. Yeah.
13.23.
13.23% is the answer. Guys, 1.2 PV negative, 14.4 FV, 20 N, and PMT 0. All those who are not putting PMT, assuming that, why should I put when it is 0? They are all going to face severe issues. Whenever there is no cash flow at any particular function, you have to overwrite it as 0. If you don't do that, the calculator is not over intelligent. It's not gonna it's going to take the previous number. So you have to overwrite it by pressing 0 PMT. If you don't do this, you will have very much difficulties in terms of getting accurate answer. Yes, everyone got 13.23?
Yes, sir.
Okay. So just for your reference, guys, China's GDP has grown by 13.23 trillion, 13.23 percentage in the past 20 years. That's a phenomenal growth rate, right? It's just a dream, and this is how China became the powerhouse in the last 20 years. From an emerging or an underdeveloped economy, it has pulled maximum people out of poverty in the last 20 years. And that's the reason why people are studying what has happened in China in the last 20 years. Good, bad, the method, we are not discussing the method that China must have grown, but just see the potential that the country has grown, like 13.23%, tremendous. Okay, now, of course, India can also grow at the same rate. We can also take our population at advantage if the population wants to. So the government of India recently, announced a very, optimistic target of, right now our GDP is at $2.8 trillion, and the government has announced that it poises to become a $5 trillion economy. Not a big number, but still, government has said that we will grow at the rate of 7% and we will reach at 5 trillion economy. So I want to know that within what duration can we achieve this target? So if you read there, India has targeted to reach $5 trillion economy from the current state of $2 trillion economy with a growth rate of 7%. So in what time period do you expect it to achieve the target at the assumed growth rate? So currently, what is the scenario, guys? What is the GDP right now? Our GDP right now is $2.8 trillion, and we are expecting to reach $5 trillion. The growth rate here is 7% assumed. And what are we looking for? N. Am I correct, everyone? Right? So, anything that I need to change in the timeline or in the numbers? Yes, I need to take the PVS negative 2.8, correct? So my PV is going to be, yes, everyone, negative 2.8. FV will be $5 million. N is what I'm looking for, right? So I'm going to find N here. What I have is I have I by Y, and I'm going to calculate N. So my I by Y in this case is 7. PMT, yes, 0. And then you will get a number. And this time that number is to be years. Anyone?
8.57.
8.57. So approximately in 8.5 years, you can expect India to reach 5 trillion in 8.5 years if it grows at 7%. However, if it grows at a rate higher than that, then you can expect the GDP to become 5 trillion much earlier, right? Now, this is where you can put any story in the time value function and get the answer. Clear? But remember, the PV and FE both cannot have the same sign, right? Any questions here? How do I get the answer? 2.8 negative, you put PV, 5 as FV, 7 as I over Y, 0 as PMT, and CPTN. CPTN, remember N is number of years here, so you'll get 8.57 years. Anyone, any question? Anyone, any questions? No? Okay. So then, are you ready for one of the last but not the least, and yet the most important calculation, that is of retirement planning?
Yes, ready.
Yes. Okay. So who manages this money for retirement planning? What are these organizations called as? Anyone can tell me? What are these organizations which manage people's retirement money? Yes. Well, there are global pension funds which manage public retirement corpus, public retirement funds. And these pension funds have probably the government employees corpus of pension investments, or any private institution as well. But those pension funds which are handling government employees corpus, which means the fund value, those pension funds have huge wealth, tremendous amount of investments, and they are said to be one of the biggest or the largest institutional investors in the world. Their asset under management is way higher than many of the banks or other financial institutions also, and therefore they have a very prominent impact in the financial markets. And yes, I'm talking about the pension funds. So here is on your screen the list of pension funds as of the current year or the previous year, which I've pulled out, and the amount of investment or the amount of assets under their management that they have. So one of the world's largest, in fact, the world's largest wealth fund, the world's largest pension fund is the Japanese pension fund. Followed after that is the Norwegian pension fund. These organizations have assets of $1.5 trillion. That's a huge amount. $1.5 trillion is perhaps the size of an economy, right? Many of the economies do have $1.5 trillion of GDP. So this is the the pension fund size that these organizations have. National Pension Fund South Korea, and then many of the pension funds from US and North America. So this is the total value, total amount under their assets. Now, we will discuss when we go to financial reporting and analysis. There are two types of pension funds: defined contribution and defined benefit. So these pension funds, how do they accumulate so much of amount? Because investors like you and me, we put our pension into a pension plan, and then these are the pooled assets. They collect money from us like mutual funds, and then they put into various different investment instruments. That's the reason why pension funds have grown tremendously, because many of the countries, they have a rule to put your money in pension funds. You have to compulsorily put. So in our country also, we put a substantial amount of our tax savings investments into pension funds, and that's why the pension fund size becomes tremendous high enough to impact the financial markets. So these are one of the top 20 pension funds globally. Now, someone like you and me who is who is planning for his retirement, maybe not now but later on, or planning to invest from today so that he or she can accumulate enough money, enough wealth, and can retire with a relaxed mindset. So how do they do that? So basically, people plan for long-term objectives like retirement planning or their children's education, or for keeping some amount for a charitable trust, or transferring that value to their next generation. So they want to accumulate a substantial chunk of money at some point of time in the future. Now that money they will either spend it in parts for their own health care, or they can spend it for their children's education or something like that, right? So here will be a scenario under retirement planning where you will be accumulating some amount by investing from today till your retirement. And upon your retirement, or maybe later on, you will be spending that money for various objectives. So those will be the scenario. So there will be multiple scenarios: your investment scenario and your spending scenario. Your investment may be at a different rate for different time period, and your spending can be at a different rate and at a different time period. So there will be multiple calculations in the entire plan. That's what we are going to see. But again, the technique here is going to be TEC, timeline, equation, and then calculation, right? That will make the sum much smoother. So let's do that. Let's do a few examples based on that. So here is the example 8A based on retirement planning. And again, I will be plotting the information in timeline. 8A is something that I'll do. And the next example, I'll be expecting you all to, help me out there. So a client plans to send a child to college 4 years. For how much years? 4 years. Starting 18 years from now. Okay. So can you tell me when is the child going to go to the college?
18.
From the 18th year, correct? Right? For 4 years. So 18, 19, 20, and 21. Clear? So they have said a client plans to send a child to college for 4 years, starting from 18 years from now. Correct? So I think the child will enter into the college at the end of 18th year, then 19, 20, and 21. For 4 years, it's going to be in the college. Having set aside money for the tuition, she decides to plan for room and board also. She estimates these costs as 20,000 per year, payable at the beginning of each year, by the time her child goes to the college. Okay, interesting. So guys, tell me, when is the child going to college?
By the end of P17.
Yes, by the end of 17. Carefully. So the child plans to, a client plans to send a child 4 years, starting 18 years from now. So when is the child going to actually enter the college? After 18 years, before 18 years, or what? Carefully, everyone, please. If you all don't participate here, it will be difficult for you all to, do the questions. And if you all always think that, after the session, I'll ask sir and then do it, then you'll miss the flavor here. Because in-depth explanation and all that is good if it happens in the class. Yes. Tell me. A client plans to send a child to college for 4 years, starting 18 years from now. Come on. I need your contribution. Only then I'll go ahead.
Beginning of the 18th year.
Okay. So I'll read it again. Having set aside the money for tuition, she decides to plan for room and board also. Okay. She estimates the cost at 20,000 per year. So first of all, 20,000 is the annuity, right? Because it is per year. Payable at the beginning of each year by the time her child goes to college. Payable at the beginning of each year by the time the child goes to the college. So can I say the child is going to the college at the end of 18th year? Which is actually the beginning of 19th year, right? And as soon as the child enters the college, at that point, not 1 year later, at that point itself, the mother here has to pay 20,000 per year. So when is the child entering the college? 18 years from now. That is at the end of 18 years. Am I correct? And when the child enters, at that time, the college fees has to be paid. So the first payment will be at the end of 18 years only. Are you getting it? Otherwise, what would have been the situation? The child enters the college at the end of 18 years. And if they had not said this paper at the beginning, I would have assumed that the child's fees must be paid at the end of the year. But normally fees are not paid at the end of the period. They are paid upfront. So in this case, the child enters the college at the end of 18th year. And at that point itself, the fees is paid. So fees paid on that day, not in the next year. Are you with me on this, everyone?
Yes.
Correct. Now, further they have said, if she starts next year and makes 17 payments into her savings account at 5% annually. So to be able to pay for her child's education, she's going to start investing something from not today, but from next year. So from next year, that is 1, 2, 3, and till 17th year, she's going to pay some money. I don't know what. For me, that money is X something, some annuity amount she's going to pay. So if she starts next year and makes 17 payments into the savings account at the rate of 5%, so 5% is the rate that they have given us, what annual payments she will make or must she make? So can I say that she's investing at the end of the period, guys, here, right? And she will accumulate some money, and that money will be able to pay her 20,000 of expenses for the 4 years. So what do I need to start first? What will I have to first calculate here? If you all have understood the theme. What will I have to calculate first? Yes.
Future value
Future.
for
Yes. What?
at the end of the 17th year.
But for that you require annuity, the annuity investments, correct?
We
So
can
how?
go back.
Yes,
Sorry. Like the present value and then the annuity.
correct. So very first you'll have to decide that how much is the amount that you require to pay the $20,000 of 4 installments, correct? So can I say I will first calculate the present value of these amount? These $20,000. Everyone? And guys, if I calculate the present value and keep my calculator at the end mode, where will I get the value at? At the 18th year or at the 17th year?
17th.
Yes. So I will get the present value of all this money at the end of 17th year. Everyone. And for that, guys, if you notice, what will I have to do here? First, in order to, how many installments are there?
17.
No.
Eight,
4.
Installments of
4.
payment,
4.
four installments, and FV would be 0. The rate is 5% that they've said, and the installments are of 20,000 each. So the 420,000, the 4 installments of 20,000, I want to check what is the present value of those installments, and that present value will be a year back. Remember, in present value, if your calculator function is at the end of the period, you get a value 1 year back. So the present value of which starts from next year, that is 18, 19, 20, and 21, that present value of all that will be at the point of 17th. Correct? So I'll get your PV 17. And what is going to be my amount? Anyone? Let me know.
70919.
Yes, 70919. Well, this is going to be your present value, which is at point 17, PV 17. Now, this is the amount that you have to accumulate by the end of 17th year, so that you will be able to pay the $20,000 of your child's expenses for the next 4 years. Got it? Now I'll move to the second part, where now this PV will become FE for me, isn't it?
Future value.
So the PV 17 is what I want to achieve. So that is going to be now my future value. So my future value, guys, here will be nothing but the same thing, right? So 70919 will now become my future value. And what should be the PV in that case, guys? Watch the timeline.
0.
What is it? Yes, very good. 0. I by Y is 5% only. Number of installment that you're going to do there. Anyone?
17.
17. And now what you are calculating is PMT. That is the installment. Yes. Compute PMT. So 17919 is your FV, 0 is your PV, 5 is your I by Y, 17 installments. So that is your N, and compute PMT. You should get an answer of. Anyone?
2744.50.
Correct. That's the answer, 2744.5. Anyone who's not getting the answer, please let me know. And also do note the functions that I'm putting on the note out here. You cannot solve the question directly blindly by just putting in the calculator. You need to focus on the timeline and then understand the technique. First, you'll have to calculate the present value, which will be at the end of 17th year, of the payments that you have to do. That is the money that I have to accumulate by investing today. So now if I were to summarize, can I say that, let's say the investor is me. So I'm going to put installment of 2744.5 starting from next year for 17 more years. So total 17 installments I will be putting up. And at the end of 17th year, how much will I accumulate? 70919. This 70919 will fetch me 4 installments of 20,000 for the next 4 years. Are you with me on this, everyone? Correct. Anyone has any questions here? Yes. Anyone, any questions? Has everyone understood why this PV becomes the FV later on? Everyone understood that? An important part that you have to also understand that when your calculator is at, see, the calculator was always at the end mode, right? I did not change the mode. Therefore, the present value of cash flows from 18, 19, 20, and 21, that gives me a year back at 17. Everyone. Anyone has any questions here? Clear? If yes, then guys, you all will have to help me with the next one. Clear, everyone? Okay. I'll move to the next part. So here, the second question is that a couple plans to pay their child's college tuition for 4 years, and see the twist now, okay? Starting 18 years from now, okay? The current annual cost is Canadian dollar 7,000. That is the current cost, Canadian dollar 7,000. And they expect this cost to rise at the annual rate of 5%. In their planning, they assume that they can earn 6% annually. So the costs are rising at a different rate and their returns on investment will be at a different rate. This question is different from the previous one, okay? How much must they put aside each year starting next year if they plan to make 17 equal payments? Okay, can anyone help me with the timeline? Or do you all want some time to first do it yourself and then discuss with me? So if you all want to try it yourself, just take, and just everyone is just going to do the timeline, okay? No one is going to solve it. I'm sure you all are not touching your calculator before you accurately make the timeline. So every one of you all take a book, pen, plot everything under the timeline. If you spend more time on the timeline, trust me, everything else is easier. Okay, so plot a timeline, focus on all the numbers, take 5 minutes. Of course, in exam you're just going to get 1.5 minutes, but you are take enough time and focus on how to get the timeline. Okay, by the time I will highlight the numbers, you can try the timeline. So couple plans to pay their child college tuition fee for 4 years starting 18 years from now. The current annual cost is Canadian dollar 7,000. Current. They expect this cost to rise at 5%. In their planning, they assume they can earn 6% annually. On how much should they put aside each year? Starting next year, if they plan to make 17 equal payments. Hmm. Okay. Anyone with any numbers here? Has anyone guessed what is the unique thing in this question?
Beginning of the year, not end of.
Okay. Plans to pay the child's college fee or okay. So how do I solve this? Beginning of the period? You sure? Okay. Still, how do we solve this? Any idea, anyone? Where is $7,000? Where should I put the Canadian dollar 7,000 in my timeline? Come on,
P18.
guys. Where?
P18.
That's the twist in this
Present.
question. The calculation Canadian dollar 7,000 is the cost today. Even though you are not going to pay today, that is the college fee today. And you are going to start paying for it not from today, but from 18, 19, 20, and 21. These time period, right?
Yes.
And they have said this cost is expected to rise at 5%. So I need to see what is this cost going to be at 18, 19, 20, and 21 at 5%. Are you getting it, everyone?
Yes.
That's the difference in this question compared to the previous one. So the first thing I'm going to do is that I'm going to find the future value of 7,000 at the end of 18th year at 5%. Future value of 7,000 at the end of 18 year at 5%. How do I do that? You can manually also do it. 7,000 instead of putting the PMT function multiplied by what is the cost here, guys? 5%. So 1.05 raised to how many years? At the end of 18, right? So you'll get this as an answer, 16846.33. Guys, in your calculator, you can solve this. How will you solve this? How will you solve this? You can solve this in a manner I will show you here in your calculator. Here, guys, press 1.05. 1.05. Everyone with me? 1.05, right? Then you have something called y over x. Y raised to x here. Y raised to x is the power. So 1.05, after pressing 1.05, press yx, this part. Everyone with me? And here, once you press this, how many years we had to go ahead? 18, right? So after pressing yx, press 18, and then press equal to. Everyone, what did you do? 1.05, y raised to x, 18 equal to. So it has compounded 18 times. Now you have to multiply that with 7,000. So multiply that part, multiply with 7,000 and then press equal to. What is the answer that you all are getting?
16846.33.
Correct. That is the amount that you should be getting here. Everyone with me on this? Correct. Everyone has got this money? 16,846. Now, tell me that this value of 16,846 is at which year? Everyone.
At the beginning of 18 years.
Beginning or at the end?
Beginning.
Just watch the question carefully. If it was beginning, then I would have done 17 years, right? 17 raised to 17.
And.
And if you read the question at the start, a couple plans to pay their child's college tuition fee for 4 years, starting 18 years from now. So after 18 years. Okay. So the cash flow at the end of 18th year that I will be required to pay is 16,846.33. Am I correct? Right? Now this cash flow that you have in your calculator, what are you going to do? You are going to store it. So press store one, store one, store one. How much is this amount going to increase every year? At 5%, isn't it? So now multiply this with 1.05. 1.05, when you multiply, it increases by 5%. So multiply this by 1.05 and let me know the amount, please.
17,688.
So 17,688 is your amount that you will have to pay at the end of 19th year. 17,688. Store this. Store 2. Press store 2. I'll keep the rounded off figure here. You can keep it in your calculator, the full figure.
18,573.
Okay, so again, you will add 1.05, multiply by 1.05. So
573.
18,573. Store 3. When you get 18,573, press store 3. And then for the 21st year,
19,501.
19,501, store 4. Everyone with me on this? Guys, if you are not with me, it's going to be difficult to come back again. Okay, so be with me. If you're not with me, tell me, I'll repeat it. So what did I do in step 1? I calculated the future value of 7,000, which will be at the end of 18th year, which I got 16,846. And then I calculated the other 4 amounts, other 3 amounts, which will be at the end of 19, 20, and 21. So these are the amounts that I need to have in my account, because these are going to be the tuition fees for my child at the end of 18, 19, 20, and 21 years. Everyone with me. So I have increased my cash flow at, cash flows had increased at, I will write here, at 5% rate. So cash flows were increasing at 5% rate. That's what they had told us in the question. If you see the question here carefully. So 7,000, and they expect this cost to rise at annual rate of 5%. Everyone. Correct? Now, I need to find the present value of all this money. Where will the present value sit? Where will the present value be at? If I calculate the present value of all this money, where will it be at?
End of 17.
Very good. It will be a year back. So it will be at the end of 17th year, right? So now if I want to calculate the present value of all this money, it will be at the end of 17th year, isn't it? So guys, in order to pull it back, right, I will discount it back at my rate of return. What is my rate of return here? 5% is the rate at which the cost is increasing. But what is the rate of return that I'm expecting? Is it same in this question?
6%.
It's different.
6%.
Yeah. So in this question, it is different. So can I say my rate of return here is 6%, and this is not 5%, right? So your costs are increasing at 5%, but the return that you are expecting is 6%. Everyone with me? So is your amount same in 18, 19, 20, and 21 years? Is your amount same?
No.
No.
No, right? And therefore, we will be using which function?
CF.
Yes, we'll be going with the CF function. Everyone with me? So what are you going to do? In your calculator, you will press CF and first clear the previous thing. How will you clear the previous thing? Second clear. CF, second clear. Where is it? Let me show you again. So you press CF and then press second and clear. By doing second clear, all the previous sins that you have done, they are all vanished. I mean, all the previous numbers are vanished. So CF second clear. Right? Now, what is going to be our CF0? Nothing. Press the down arrow key, you will get C01. What is going to be our first cash flow? Remember, you have already stored all the cash flows, isn't it? Right? So when you come to C01, press recall 1, recall 1, recall 1. Only once. Guys, if you press recall 1, what do you get on your screen? Are you getting your previous amount or not?
16,846.
Yeah, that's the amount that you had, right? So when you do recall 1, press enter. If you don't press enter, it won't understand that you have to capture it. So when you get recall 1, right, press enter. So now in your calculator, it will be C01 16846. Is that the thing, everyone? No?
Yes, sir.
Yes. Okay. So that is your first cash flow. Now you press the down arrow, your frequency, leave it as it is. It's going to be 1. Press again the down arrow in C02. What will you do in C02? Can anyone tell me?
Recall to.
Yes, recall 2. So in C01, press recall 2 and enter. Don't forget to press enter, okay? Otherwise it will not capture. So recall 2, enter. Then go to C03, recall 3, enter. Then go to C04, recall 4, enter. Keep doing that. And once you do that, then press NPV. After the 4 cash flows, press down arrow key and press NPV. Yes. Anyone with the answer?
62,677.
62. Yes, correct. So your answer in this case is 62,670.
7.
Okay, 62,677. Everyone is getting the same answer.
Yes.
677 I can put here. Okay. So this is the value that I will be accumulating at the end of guys
17.
17. But for this, what is my present value at the end of 17 is nothing but the future value that I want to accumulate, right? And when is my investment going to begin? At the end of each year for 17 more years. Clear? Now it's very much easier. What is the future value you want to accumulate, guys? You want to accumulate 62,677 as your future value. Your PV will be 0. Your I, very interesting. What is going to be your I?
6%. 5.
6 or 5? See,
6.
your costs are increasing at 5%, but your returns are at 6%. Okay.
6%.
And how many such installments you are going to pay? 17. That will give you PMT. Yes, your annuities. Let me know. Anyone? So your FE, PV is 0, I by Y 6 and 17, and your PMT is
221.
221.
0.57.
0.57 or 0.5. Everyone, what was the interesting thing in this question compared to the previous one? Here, you were not given the amount that you will be paying at the end of 18, 19, 20, and 21. You had to find out that. Okay. In the previous question, the amount was same. Here, the amount is going to increase at 5%. And the cost today, they've given 7,000. So I had to find the value at the end of 18, 19, 20, and 21. And they all are different. And therefore, I use the CF function because CF function is used when the cash flows are not the same. Correct, everyone? That's a twist in this sum. But again, focus on the timeline. The second important thing in this sum was the costs are increasing at 5%, but the returns are at 6%. So whenever you're discounting everything, you're discounting at your rate of return, which is 6%. But when you are trying to find out what will be the costs were increasing at 5%. Just follow what is the instruction in the question, and only then If you don't plot all this information properly, the timeline, then your equation and calculation both will be wrong. So if your timeline is correct, everything else is correct. If your timeline is not correct, then everything else is just house of cards. Clear, everyone? Anyone has any doubt? Guys, highlight this question, because after today's session, what you should do is that you should practice this question again by solving the timeline. Right now, even if I do this 3 times, you won't remember it. The important thing is that, are you able to crack it after the session, after a gap of few hours also, or not? So just highlight this. So once you're done with the session today, then again try to plot a timeline for this question by reading it and then putting up the equation and everything, right? You do this question accurately, almost all your concepts are tested here. Anyone, any doubts here? Clear, everyone? Okay. I'll quickly show you all what the index is. So now if you focus on the index, what are we done with? We are done with everything in this part except the interest rate component. So we are done with part B completely and part A also, except the interest rate component. Do you remember a discussion of interest rate in the first session? It is also called the required rate of return and so on. It is derived by the demand and supply factors, which are the borrowers and the lenders, right? And of course, the central banks also influence the interest rates. So let us understand that the central bank has, for simplicity, let us understand that the central bank has decided the rate of the interest. So what is that interest rate called as? Point number 1, technically. And how is that interest made up of? Why is the interest rate of India higher than that of the European nations or America? Why is the interest rate of Venezuela higher than that of India as well? Why are some countries having negative or zero interest rates? What is interest rate made of? If you understand that, then you will realize why countries have different interest rates. Not all countries have same interest rates, and interest rates are very important factor for the money supply and the growth of your economy and inflation. So interest rate does play a very vital role, and therefore now we need to check what is the interest rate made of. That is what I say, the component of interest rate. So first of all, the interest rate that you see in the market, that is called nominal interest rate. What is it called as? Nominal interest rate, everyone. Now, this nominal interest rate is made up of 2 things. Nominal interest rate is made up of 2 things. And if you focus here, it is made up of nominal risk-free rate and a set of risk premium. So nominal interest rate, which is also called as simply interest rate, is a combination of 2 things. What? Risk-free rate and risk premium, everyone. What is risk-free rate? Risk-free rate. Risk-free, which means there is no risk, correct?
Government bonds.
Yes. Government bonds are said to be risk-free. Can a bank FD said to be risk-free if you deposit, term deposit or fixed deposit in bank? Is that risk-free?
No.
After what has happened in the last 4 or 5 years, where you've seen big and small, all banks go, underground and finish. No one, I'm sure. Yeah.
Till 5 lakhs, it's risk free.
Till 1 lakh, I think, till 100,000. That is the only amount guaranteed by the Central Bank of India.
बढ़ाया ना budget.
Okay, so now they have increased to
5 lakhs.
okay 5 lakhs. But that's it. And
Bus.
so even if you put any amount that you put more than 500,000 is at the mercy of God, right? Anyway, so banks are also not foolproof safe investments, right? And therefore I cannot say that my money in bank is completely safe. So banks are not, the amount that you put in bank is not called risk free. Risk free means something where there is no risk, and the biggest risk I'm discussing is the credit risk, that is the default risk, everyone. So government bonds are said to be risk free. Even if the governments you don't trust, the government bonds are said to be risk free. Why? Because governments do have that magic wand with them. What is the magic wand that they have? They can always and always and always get the money flowing. How? How can the governments do that? How can the governments always have enough money?
Printing it.
By printing it. Correct. That does not mean that the government can keep on printing the money forever, because the more the money you print, the more will be the supply of money, the lesser will be its value, and there will be high inflation. So even if money printing is not restricted for any government, if you print more than your limits, if you print too much of a currency, then your situation will be much like a Zimbabwe or a Venezuela, where the inflation is rooftop. Correct, everyone? So risk-free investments are basically government bonds. They are said to be virtually risk-free. Now, so let's say the government bond in India offers a rate of, I should say, let's say 5%, just an example. So that 5%, that is called as nominal risk-free rate. Now in that nominal risk-free rate, there are two components. In the nominal risk-free rate also, there are two components. One is the real risk-free rate, and the another is inflation premium. Remember, in a country, even if you put your money in a locker, the value of the money will keep on depleting, and that is because of the cost of inflation. Inflation is something that is the loss of your purchasing power. So the nominal risk-free rate that the banks are offering you, or the government bond is offering you, it has two components in it: real risk-free rate and the inflation premium. What is real risk-free rate, guys? Real risk-free rate is the single period interest rate for a completely risk-free security if there was no inflation. But if you add the inflation, which is the loss of purchasing power, then with that in average inflation that you consider, what you get is a nominal risk-free rate. So nominal risk-free rate is a combination of two things: real risk-free rate and inflation premium. So here's a question for you guys: in what case the nominal and the real risk-free rate will be same? In what case the nominal and the real risk-free will be same?
In case there is no inflation.
No inflation.
In case there is no inflation, right? But we do know that inflation in a country, in an emerging economy like India, keeps on increasing. The price rises of various commodities, especially fuel and all. So if the inflation is going to increase, can I say your real risk-free or real rate will increase? If your inflation increase, can I say that your real rate will increase?
Nominal rate will increase.
Yes, I cannot say the real rate will increase, but the nominal rate will increase even if the real rate remains. So if the real rate is 5%, let's say if the real rate is 3%, but if the inflation is increasing, guys, then the nominal rate will keep on increasing. And if the nominal rate, that is the rate of government bonds, if that will increase, then definitely the interest rate, the overall interest rate in the economy will also increase. Why? Because the nominal rate is a combination of nominal risk-free plus risk premium, everyone. So if inflation increase, what will increase?
Nominal.
Nominal, no. Say it completely. There are two nominal here. So if inflation increases, your nominal risk-free rate will increase. And if your nominal risk-free rate increases, then your nominal interest
rate.
clear. So banks will automatically increase the interest rate because of the rise in inflation. Right? Now, the countries where the interest rates are so low, that is perhaps because their inflation is almost zero. In countries like America or Europe, North America or Europe, or in countries like Japan, the inflation is almost negligible. Well, if the inflation is negligible, then the nominal risk-free rate will be lower. And if the nominal risk-free rate is lower, then the nominal interest rate will also be low. Got it? But if the inflation is too much high, like that for Venezuela, or even for that matter, many other South American nations like Argentina, they have high inflation. Even Turkey had a high inflation. So the Gulf, many Gulf countries who are right now in the war, like Yemen, even they have high inflation. So if the inflation is high, the nominal risk-free rate will be high. And if the nominal risk-free rate is high, then the nominal interest rate will be high. Everyone with me on this? So nominal interest rate is a combination of two things: nominal risk-free rate and the risk premium. Risk premium. Why is the risk premium? Risk premium is the premium for investing in a security where there is risk. So if I give you two choices, guys, if I give you two choices, investing in a government bond, investing in a government bond, which offers you 8%, and investing in a corporate bond which offers you at 8%. Where will you park your money?
Government.
Government bonds, because in government bonds, you know that there is no risk, correct? But in corporate bond, there is a risk. So if the risk is same, you will, of course, if the risk is same, you will choose the one which has higher returns. But here in this case, if the returns are same, you will, of course, choose that investment which has lower risk, isn't it? And therefore, the lower risk is with government bonds. So for me to make you all invest in the corporate bonds, I'll have to offer 8% plus something for the risk to compensate the risk. Let's say I offer 2 more percentage for you to compensate for some risk, and that's where I give you 10%. Now you may think, okay, now probably I'm getting 2% extra, and that 2% extra is for the risk that you are taking. That risk is not present when you're investing in a risk-free asset like government bond. Are you getting me? So the risk-free rate here is 8%, and I need to add some premium if you are investing in a risky security. That risk premium, that 2% in this case, can be a component of various risks. The three set of risk premium that we are focusing here is the risk of getting default, which is called as the default risk premium. What is default risk premium? That the borrower will not be able to pay your money back, right? Second is the liquidity premium. What is liquidity? What is liquidity? What comes to your mind? Liquidity?
Cash.
Easily converting to cash, right? Is real estate more liquid or equity more liquid?
Equity.
Because you can easily sell equity on the stock market, but real estate you can't easily sell it. And even if you want to sell and quickly get money, there's a high cost. You may have to end up paying you may have to end up getting a lower value if you are in a hurry, if you are really looking for quick money. So default premium is when the borrower will fail to pay. Liquidity premium is when you are not able to sell your investment, and therefore you sell it desperately by having a loss. So if you're not able to quickly convert your asset into cash, that is where it is called as liquidity risk, and therefore you need to have some liquidity premium for it. Selling government bond is much easier because it has high liquidity, but selling a corporate bond, which may be of a low volume, it's difficult to sell at times, and therefore they may have a liquidity premium also. Correct. And the final thing is that maturity premium. Maturity premium basically is the premium for the maturity of the bond. So the longer the maturity of the bond, the more riskier the bond becomes. We'll discuss about this when we go in bonds in much detail. Bonds basically fixed income. But here, just for your information, which bond is riskier? A 2-year bond is riskier or a 10-year bond is more riskier? Which bond do you think is more riskier?
10 years.
10-year, right? Because in 2-year bonds, you'll get your money back in 2 years. But in a 10-year bond, you have to wait for 10 years and things can drastically change in 10 years, right? Just look out at the scenario. The companies which are most valuable 10 years back, where are they today? Are they either they are extremely highly valuable or they are not in the business at all? So things change drastically in a period of 5 to 10 years, right? Therefore, the longer the maturity, the higher is the risk, the more is the sensitivity of the bond. When I say sensitivity, which means the bonds fluctuate a lot. So 3 set of risk premium you have. Which risk premium? Default risk premium, that the borrower will not be able to pay you back. Liquidity risk premium, which is when you're not able to sell it quickly. And the third is the maturity risk premium, which tells the higher the maturity of the instrument, the more is the risk, the more is the sensitivity. You need a compensation for all this risk, and therefore that risk premium plus the nominal risk-free rate together will become the interest rate on whatever instrument you're looking at. Clear, everyone? Anyone, any questions here? So guys, can you tell me what is nominal risk-free rate made of? What is nominal risk-free rate made of, guys? Real risk-free rate and inflation, correct?
Yes.
And what are the risk premium components? Default risk premium, liquidity risk premium, and maturity risk premium, correct? I'll repeat, everyone, and you don't have to mug up. You have to understand concept. Nominal risk-free rate is a combination of real risk-free rate plus inflation. And risk premium, there are multiple risk premium, which can be default risk premium plus liquidity risk premium plus maturity risk premium. And guys, if I add the nominal risk-free rate plus the risk premium, what do I get? Yes.
Nominal interest rate.
I get the nominal interest rate or simply the nominal rate. Everyone with me on this? So now is the time to answer few questions. Can you solve this? Here you are being asked if the nominal rate of interest is 8.5, risk premium is 2, inflation premium is 2.5. You have to calculate the real risk-free rate and the nominal risk-free rate. I give you all 2 minutes to solve this and you can let me know. First, everyone will try themselves and then let me know. Take your time. Everyone, take your time and let me know the answer. What is the first thing you will get? Anyone?
Nominal risk free.
Yeah, you'll have to first solve the nominal risk-free. So your nominal risk-free is real risk-free plus inflation premium. And here you have the nominal risk-free. Do we have? No, but you have the real risk-free. Do we have the real risk-free? No, you don't have the real risk-free also. You have the inflation premium, which is 2.5. So you don't have the real risk-free, neither you have the nominal risk-free. But you are given that the nominal rate, so nominal rate of interest, I know the nominal rate of interest is nominal risk-free plus risk premium. So here the nominal interest rate is given to me as 8.5. I don't know what the nominal risk-free is, and the risk premium they've given me is 2%. So based on this, I will get the nominal risk-free rate, which is 8.5 minus 2, 6.5%. Everyone with me? And that nominal risk-free rate, you add in the equation here 6.5, and then you'll get real risk-free rate. So your real risk-free rate will be 6.5 minus 2.5, and that will be 4%. Everyone. So the nominal rate is 8.5, I can say, out of which the nominal risk-free is 6.5 and the risk premium is 2. Within the nominal risk-free, you have real risk-free as 4 and inflation premium as 2.5. And the risk premium, they have given 2, which I can assume any of the risks. Clear, everyone? Anyone has any questions? Yes. Anyone, any questions, any doubts? Please let me know. So ideally, the component of interest rate is discussed with the interest rate itself. However, I've put it at the end. So just for the, after all the calculation, this discussion, I've kept it at the end. I don't do it at the start. So you can read it whenever you want, no issues. So conclusion, nominal risk-free rate is real risk-free rate plus inflation. And then if you add risk premiums to it, default, liquidity, and maturity risk premium, then you get the nominal interest rates. Anyone, any questions? No questions? Well, then that's the end of, not today and today's session, but that's the end of reading number 6. Correct? So in reading number 6, now we are done with all the ingredients, all the different types of calculation that you would probably come across in the future as well. There are many more calculations, but we'll see that topic wise. Everyone, the most important topic for me in quants, which is actually going to impact several subjects of yours and your foundation, is the time value of money. Now, we are done with time value of money here. What we are going to, yeah, we will take a break of 5-10 minutes and come back. But before that, I'll tell you that I'll start after the break reading number 7, that is statistical concept. And we'll be covering a substantial part of reading number 7 after the break as well. But, at the end of the session today, while I'll be discussing the doubts and what is going to be the next session, I'll also be discussing with you how you should go to the portal of our platform and give the test. Yes, your test for cons is ready for time value of money. A 20 question test. So it's a half an hour test. 20 questions, 1.5 minutes for each. So 30 minutes. So 20 question test is there. I'm not expecting you to give the test immediately today. I'll give you all a few days to work out and then do the test. So I'll discuss that in detail after the at the end of the session today. Okay. So what you will be doing is that you'll be revising what is done in the class, and then you can refer to the books that you have. You can refer to the any notes you have. You can also refer to the Schweitzer notes that you have bought, and you can go through that. You can go through all the questions there in the book. You'll be able to do all the questions with these notes. So you practice that, and then I'll tell you a time frame after which you will be giving the test. So everyone will be giving the test. Everyone's performance will be visible. So you'll keep a track of your performance also, and I'll get a track of your performance. So it's going to be very much a feeling like what happens in the real exam, a computer-based test, and the test is not a choice for you, it's compulsory. Okay. So I'll discuss in more detail about how to approach the test and all that thing at the end of the session today. So let's take a 10 minutes break. And after that, when we come back, we'll start with reading number 7. Correct? Okay. Let's meet after the break.